Today, I have the pleasure to have Mindy Mayman. Mindy is partner and chief compliance officer, and also a portfolio manager at Richter's family office. I hope I have that right.
Yes, Richard.
Great. So, welcome, Mindy, to the podcast.
Thank you very much for having me.
It's my pleasure. It's my pleasure. So I just want to make like a 101 course on a family office, how it works, and how do you structure it? Because people might think sometimes when they hear family office, it's an office in someone's basement, maybe in someone's family's basement. So I just want to educate my audience in regards to that. So what is a family office?
Well, the interesting thing when you refer to family offices, Richard, is we have a saying that says, if you've seen one family office, you've seen one family office. And what that means is that family offices range from servicing one family and having all of those services at the family office, to the type of business where I work, which is a multifamily office, and we service multiple families. So the challenge is that when families build their family office, they typically build it in their own image, and it's rare that two family offices function exactly the same way. But they do run the gamut from the very sophisticated, which, as I mentioned, might service a singular family. They might be very organized and have a lot of in-house expertise. That could mean the family office has its own board of directors. They might have teams of people that handle things like accounting and tax and estate planning. They could handle portfolio management and investing internal to the family office. They might also deal with risk management issues for the family, which could range from insurance, like life insurance. It could be insurance on the various types of properties or assets they have. It could even concern cybersecurity and the physical risk associated with being a very well-known or high net worth family member. And so that would be a really sophisticated, large family office that would build out these types of functions internally. And then depending on the family's needs and the size of the family's worth and their situation, they may choose to outsource some of these functions. So as an example, the families I typically work with, they outsource most of the investment function to Richter. They outsource their accounting and tax compliance and planning to Richter. We definitely help them in their estate planning. So we would handle one piece and then coordinate on the legal front. They certainly outsource matters of cross-border taxation. More and more, we have families that have family members outside of Quebec or Canada, as the case may be. And then they may need some other professionals that surround them. Sometimes at different points, families will use a facilitator to help them build their family governance or hold family conversations. As I mentioned, depending on the family situation, they may need special expertise in different areas.
Okay. And what's the net worth of the family usually?
So the families that we work with typically have net worths in the tens of millions of dollars. So that could be 30, 40, 50 million dollars. And if you also consider families that still have operating businesses, it's not unusual that their net worths would be in the hundreds of millions of dollars. Typically, the families that have their own family office, where they really insource a big team, as I described, those would be families that have net worths in the billions of dollars.
Okay. Is there, correct me if I'm wrong, is there such thing as a virtual family office?
I don't think there's such a thing per se, in that it's not a product or service in and of itself, but certainly we all use virtual components to help service families. So, for example, you may want a virtual family vault where family members all over the world could get secure access to documents. They may want to keep things like wills and insurance policies, financial statements, tax information in a centralized location. They may typically hold meetings virtually for various reasons, but most family offices do have some type of physical family office space depending on the family.
But don't they also service an individual per se, just one person instead of a family, or it's just a family in general?
I mean, a family could be constituted by one individual. When family offices originally were born, the concept of the family office was typically that a very wealthy family wanted to ensure that this wealth was passed from generation to generation. So while it's not impossible to service a singular family member, there is normally a notion of continuity and wealth stewardship associated with family office. And that's why we typically speak about a family. It may be that the wealth creator is the one who started the family office, but if the goal is to pass the wealth to subsequent generations, then typically there's involvement at some point of those generations, or at minimum, planning for passing the wealth to those generations.
And why would the family office, the people, the individuals, uh, doesn't use a bank? So why would they choose a family office? What are the differences?
So, first and foremost, when we speak about family office, it is true that most family offices have an important component around asset management. And that's certainly where a bank could come in. And banks are involved in this industry, no doubt. But a true family office is a fulsome suite of services that surrounds the family. And so, as I mentioned, that would include things like accounting functionality, tax planning and compliance, estate planning, risk management, legal advice, insurance, philanthropy. All of those things really form part of a family office concept. So the banks certainly are in this industry, and they can certainly provide or assist with some of these services. But normally, very sophisticated families also need accountants, lawyers, insurance people in their midst. And so most people don't use a bank as the only family service component they work.
Okay. And when it comes to the main assets inside the family office, where do they deploy the capital mostly?
Right. So again, that's unique to each family. First of all, some families start their family office while they still own the family business. Most of the time, that is the source of the wealth. And they may have an objective to continue to hold and run and manage that business. Other families start their family office after they've sold off the business, and really it is designed to run the financial capital of the family. And then families make asset allocation decisions. So for sure, they use financial assets like stocks and bonds. They very commonly also go into the world of private investments. We could think of private credit, private equity, real estate. Many of them will also do direct investment. So they might invest directly in companies, remembering that the genesis of family wealth is typically that someone in the family was an entrepreneur and started and grew a successful business. So they tend to have typically some type of entrepreneurial spirit or positivity. And so many of them even go and make direct investments on their own.
Are there, because you said multifamily, are there any co-investing? Do you guys do that? No?
So that's definitely a trend that we see. There's many ways to do co-investment. So on behalf of our families, the way we would think of a co-investment is we use external managers to build our family's portfolios, and those managers will bring us co-investment opportunities when they have an investment that is larger than they can make in their own firm, and they invite others to partake. So in our case, that would be a co-investment. But there is certainly more and more a trend of high net worth families teaming up and working together to invest, for example, in a direct investment where they would make an investment in a company or they would finance a company.
So the deal sourcing, where does it come from mostly?
The deal sourcing depends on the type of deals that they're looking for and how they build their team. So again, a family might decide that they have deep connection and knowledge of a certain industry, most likely because that was connected to the operating business at some point, and they may be able to source a lot of deals on their own. Some family offices hire deal teams who have former deal experience. So those are typically people who at some point have worked in the institutional money management world and have connections there. And so they naturally have contacts through which they source deals. And sometimes it is simply by high net worth families networking together, and then the source of the deal is any one of those families that brings the deal to the group.
In regards to the diversification, usually when they construct a portfolio, they say 60% stocks, 40% bonds. How do you diversify, like the percentage for the assets?
So we think about that a little bit differently, and it is predominantly because we are working with high net worth families. We would look more like a pension plan in the way we build portfolios than a traditional 40% fixed income, 60% equity mix. And when I say that, what I mean is that we will incorporate private credit. So that's lending in the private markets, not just buying bonds on the public markets. We would incorporate private equity, whether it's buying an individual company through a co-investment or investing in a private equity fund. We will do direct investments in real estate funds. We will look at hedge funds. And we will also look at unique transactions that in our world we call uncorrelated transactions. So that's a portfolio that would look more like the Caisse de dépôt, the Ontario Teachers Pension Plan, with the various components. The reason we're able to look at all of those sub-asset classes is that high net worth individuals can allow themselves to have a portion of their portfolio that is locked up for several years at a time. I go back to that notion that these are typically intergenerational portfolios. The challenge for most people is that they need to rely on that portfolio and they need to be able to liquidate their assets quickly. And so it is not as easy for them to look at these other types of assets and incorporate them in their asset mix.
In regards to decision making, how does it work?
So it's very important that a family establish a decision-making framework, not uniquely for portfolio management, but frankly for all important decisions. And that is because the last thing you want is when there is conflict in a family for it to break up the family. And we've certainly seen in the news over the years different families where things have happened and there hasn't been agreement, and that is not good for family unity. So one of the responsibilities of the family office when we speak about family governance is for the family to establish what the decision-making procedures will be among family and professionals that are engaged by the office, and also how conflicts will be handled, because we are all human beings and inevitably conflicts arise. So there isn't one correct solution. And different family members or professionals may be responsible for decision making in different areas of the family office. The most important thing is that that framework is constructed and thought about and followed and changed as necessary.
How do you deal with risk management?
Risk management can take many forms for high net worth families, as I listed a little bit earlier. I focus more on portfolio risk management in my day to day job. And the interesting thing is, you can quantify risk for families, but in many cases, it still feels very intangible to families. And so we try to think of many different ways to talk to families about risk. So one of the things that we do is we will model for families what could happen if this portfolio is existing in a time when stock and or bond markets lose a lot of value. What's the impact to the portfolio? And what does that mean, not just in percentage terms, but in dollar terms? So that's one of the things that we do with families. The other is we try to help them think differently about their portfolios, because these are typically very long-term investments. So sometimes we give them a pyramid as a framework, and we ask them to think about their portfolio in three separate buckets. The bottom being the foundation, and that's the part of the portfolio that will typically be in lower risk investments, and that should not fluctuate very much. Some of our families in that foundation, if they live off their portfolio, will want to know that there is 5 years worth of expenses that they can count on as part of the foundational bucket. We have another client who thought of it differently. He said, I want to know that I always have a certain amount of money that is bulletproof. And his definition of bulletproof was, no matter what happened in the market, I never want my portfolio to go below that bulletproof value. So that's the notion of the foundation. The next notion is what portion of the portfolio will be devoted to inflation protection. Because the truth is, for these families, their biggest risks are inflation and taxes, because that's what erodes their wealth over time. So we think about that, and that will typically be different types of investments. We could think of things like real estate, equities would fall into that bucket, among others. And then the last part, which is the top of the pyramid, we tend to think of that as the growth piece of the portfolio, which is not to suggest that the other investments will not provide growth by virtue of return. But our families think there again, typically of two different things. One is, if you pass wealth down from generation to generation, most often there is a natural dilution effect. And what that means is if there's a man and a woman that are the wealth creators, and they have two children, when they pass the wealth on, it will be divided in two. And if each of those two children has two children, the wealth will now be 25% when it's passed on to generation 3. So that typically is a natural occurrence. And if you don't continue to grow the value of the wealth, then eventually over time, it can be meaningfully diluted. So some clients think of that top tier of the pyramid as being higher return seeking investments. You could think, for example, of a venture capital fund or a direct investment. And the goal there is to earn outsized returns on a portion of the portfolio, and that will help counter the dilution effect. That's one. And then we have other families who think about it and say, under any circumstances, they're comfortable that there is enough money for the family. And if they can earn outsized returns on a portion of the portfolio, that allows them to share more with society.
What about if when they want to do foreign investments? How does that work?
So our clients very often do foreign investments. The most important element when it comes to foreign investments for high net worth families is taxation. And one of the things we've done is we do not only investment due diligence before adding an investment to our platform, we also do tax due diligence, because the biggest difference between the institutional world and the private client world is that institutions most often don't pay tax. So for private families, which is our case, taxable in Canada, we need to make sure that the after tax return makes sense for the risk that the family has taken. So you have to think about that before you make the investment, so that you don't end up in a situation where you've made an investment and you lose so much of that return to tax that you didn't get paid for the risk you took.
And what are the challenges that family faces besides, maybe you're gonna say like the taxes and all that, but besides that, like what other challenges that the family might face in regards to wealth transfer and wealth management?
I think families face a number of challenges. One is typically there's a wealth creator that started this chain of events. And that wealth creator probably was a highly successful entrepreneur because they were typically the one in charge, the decision maker, and they actually created a lot of this success. So when you talk about transferring wealth from one generation to the other, there's naturally a succession and transition that comes into play. So that can be a challenge both for the wealth creator to let go and for the next generations to be in the right position to take over that role. So that involves educating the next generation. That involves a lot of facilitation with the family so that they can understand how and when these roles will transition. And that is key to successfully passing down wealth over time. As we mentioned before, there's also the element of creating a governance framework so that as the wealth gets passed down and more family members are involved in decision making, that it doesn't cause conflict in the family that leads to the family splitting apart or fracturing.
Okay. And I believe you do at Richter, you offer on the personal side, but you offer also on the business side too. So talk to us about that.
Correct. So interestingly, at Richter, we call ourselves a business family office. And if you were to search that, you won't find a common definition. We like to believe that that is our creation. And the idea really is that Richter started 100 years ago in Montreal. Originally, we were an accounting firm at our roots, but from the very first day, we always dealt with private entrepreneurial businesses. And we typically have worked always with the owner managers of those businesses. And as their businesses grew and our business grew, we continued to add on services to meet those entrepreneurs' needs. And so today we call ourselves a business family office because we have two platforms. One being our business advisory services that are adapted to the business itself. You could think of things like audit, tax, valuation, litigation, and transaction support, human capital, risk management on the business side. And then we built, starting some 25, 26 years ago, our family office platform where we offer the services we've been discussing, along with operational services and compliance services for family offices. So for a family that doesn't want to build all of this in-house, they can outsource the management of the family office to us as well. And so we offer both. And we really have a deep understanding of families' needs because we've grown with them through their businesses over many generations. we've experienced business transition and family transition. And so it was a natural for us to then add the family office component.
Where can people learn more about you and about the firm?
Sure. So one of the best places is at richter.ca, and they can certainly find me on LinkedIn as well.
Okay. Thank you very much, Mindy. I really appreciate it. So I hope everybody learned something. Thank you once again for accepting my invitation. On that note, everybody, thank you for taking the time to listen to the podcast, and we'll see you on the next episode. Bye.